On seeing some key inflation data coming up, but you think we can punch through some of these near-term catalysts?
I think so. I think that what you've seen in the last couple of days in terms of the reversal of that momentum led by NVIDIA may be more of a technical component than a fundamental one. Remember, this is month end, it's quarter end, we're up 15% for the year, there's some profit taking, and in general right now there's sort of a malaise or lack of catalyst to take additional risk. So most of, if I come on once or twice a month, every conversation we've had over the last 18 months, I could tell you that asset managers, hedge funds were below their historical level of investment. That has dried up, which is why you've seen a little bit of the market melt up that we've seen. Whether you're talking about hedge funds, whether you're talking about long only, whether you're talking about market neutral, everybody's pretty close to as invested in history. So now the market is looking for what is that next catalyst. And as we've discussed a couple of times, and I've heard other people mention this morning, we think that catalyst is going to be earnings.
You do. We're looking for about 9%. It would be the best bottom line quarter in a couple of years, right?
Yeah. So, we're coming from an earnings recession, which didn't seem to stop the momentum. And now we're relying on that earnings momentum as opposed to multiple expansion. We do see that 9% as being attainable this year with something not so different after. The ultimate question will be the breadth of that 9%, right? Do we have the haves and the have-nots in the 7 versus the 93 or the 1.6 versus the 493? We do think that we will see most every sector propel into earnings, although it may be more Q3 and Q4 based for some of the non-IT and industrial spaces.
So every sector will propel. Does that mean that there will be winners and losers within each sector that you're kind of focused on, and how do you extrapolate the macro environment to where you might see those winners versus losers?
Look, so I think we are getting to a point where there is certainly a re-rating up of most companies. So there is probably more relative than usual ability for an individual company to disappoint based on the specifics of their market. I know I heard this morning some talk about UPS versus FedEx. For example, same industry, but the way they approach their EPS and their margins is very different. So I do think that disparity will exist. And ultimately, that's what we're looking for, which is to see some disparity between how companies are rewarded, which can help not only the whole index come up, but non-beta, so alpha managers, whether it's a hedge fund or a long only, produce some additional value.
As far as rates go, it's been an interesting week. We've had at least one Fed official talk pretty hawkishly. CPI runs hot in Canada, Australia, 10-year 4.31.
Yeah.
Is that, what do you think about that? And I see real estate on your least preferred list right now.
Yeah, so let me talk about the first thing. So what came out of Canada and Australia, especially Australia, is super concerning. However, what I would say is that I think certainly we at UBS and most of the street has been really clear that pre-pandemic there was sort of this global accord of what was happening in markets for the expansion, and that coming out of the pandemic it would be disparate, that different countries, different economies based on what they were driven by, demographics of their population, would both recover and experience inflation at different rates. So we're seeing that. So yes.
Oh, I was just going to ask if that's also partly due to kind of the deglobalization that we're seeing, the decoupling, and maybe that's not necessarily true for an Australia or a Canada, but kind of broadly.
Absolutely. I think, and one of the areas that we are really bullish on is investing in industrials because of the reshoring and the Made in America concept. America, our U.S. S&P is largely 60% of the global capital markets, right? So that's partly why we receive so much flow and investment from overseas, whereas there are very few Americans who talk a lot about investing in non-U.S. assets. We do think there's a portion that should be there. We do see the Fed moving. We do see that happening in September and December. It is certainly possible that that gets pushed further back into 2025. You saw the market's reaction, or let's say lack of reaction to that concept in the last Fed meeting, but we are much more focused on the directionality of interest rates and the directionality and supportive nature of growth still existing. So we are talking about slowly slowing and how you invest into a slowly slowing economy.
Right.